Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is your 283rd VideoCast podcast for the week ending March 20th, 2025. A lot of great stuff to cover today, but first, we're going to do family first, as always. This was an incredible photo we had this week coming home from one of Mimi's water polo games, so that was that. As for the results, Mimi's team, 12U girls, played 16U girl tournament, and they lost all 4 games, which was surprising as you're watching because you're forgetting that they're playing against 16-year-olds until we went into the parking lot on Sunday night after the 4 games and we saw half of the girls that they played against get into the driver's side door instead of the passenger side door and put the keys in the ignition and drive away. So I think it was a great experience. It was not a blowout, so they held their own against girls that were 4 years older than them for the most part. That was pretty exciting. And then Annabelle set 3 records this past weekend at the Southern California Age Group Championships. 2 team records and 1 California swimming relay record. She's now number 1 in the country for 10 and under in both 500 freestyle and 100 backstroke. So awesome stuff there. That's on the Instagram for her team and her teammates who did an incredible job with the relay. And I think that's that. And these are the times: 5:24.96 on the 500 free, and that's that. So very, very exciting stuff. And then we had the most incredible week and the most incredible opportunity to interview the CEO of Cooper Standard, Mr. Jeff Edwards, the chairman and CEO. And, you know, you're going to be blown away by how Jeff explains the company, where it's been, where it is, and where it's going. But one of the key themes of our podcast for the last 5 years has been to burden yourself with the facts. And my good friend and client, Damian L., got me these caps. They're Nike. They say burden yourself with the facts. Great Hill Capital. Absolutely incredible. Tag still on. We've got 10 of these. And what I want to do this week is we're going to run a promotion for the 10 or so best responses. You're going to comment below in the YouTube section of the comment section and say, what was your number one takeaway, or what did you learn from listening to Jeff Edwards in this interview, which they've posted on their investor relations part of their website. You can go to cooperstandard.com. And then we posted afterwards on YouTube, and we posted on our site. So if you had a chance to listen to it already, you can skip through this part. If you didn't, definitely listen in. Try to take some notes. We found this really valuable. And out of the comments below, I'm going to have Jeff pick 10 that are the top 10 comments takeaways, and we'll reach out to you to get your address and mail you out one of these one-time only Nike burden yourself with the facts, demonstrating that you took the time to educate yourself and look at all this. Because a lot of the stuff that he shares, if you've done your research or been part of the podcast and also done your research, you would already know this. But Jeff did a good job explaining it in a way for everyone to understand in a more granular way. As always, this is opinion, not advice. Check with your financial advisor, click on terms, etc. But without further ado, I'm so grateful. I want to thank especially Jeff Edwards, John Banas, Roger Hendrickson over there at Cooper Standard for making this all happen. Here you go. Well, everyone, I'd like to welcome the chairman and CEO of Cooper Standard, Mr. Jeff Edwards. Thank you so much, Jeff, for taking the time to be with us today.
Thanks, Tom. I'm looking forward to our conversation.
Yeah. So a little quick background for the listeners here. Obviously, we are large shareholders of Cooper Standard, so full disclosure there. We got involved with the company in May of 2022. We thought we were geniuses buying the stock in the fives, and then it immediately went into the threes, and we bought more because we had done our work. And the stock was down because they needed to refinance the debt. They did. That largely gives them runway well to 2027 and beyond. And we're going to talk a little bit about that. We think well beyond. The idea for getting involved in Cooper Standard was actually a person that I look up to tremendously, who recently passed, is Charlie Munger. And Charlie Munger did a very similar investment in the 2001 recession, a cyclical trough in the industry. And this is a pretty regular occurrence, as Jeff will tell you, in the auto business. It is very cyclical. Charlie read an article in Barron's, and he invested $10 million in Tenneco when it was down some 95%. They refinanced the debt. He turned the 10 million into 80 million in a reasonable amount of time. And then he gave that 80 million to Li Lu, who invested in China, which was out of favor, and turned it into $500 million. So 2 chess moves, $500 million. That's the good news. I think we're going to do a lot better with Cooper Standard than Charlie did in Tenneco. And that's why we have our very special guest, again, Chairman and CEO of Cooper Standard, Mr. Jeff Edwards. Thank you again. So I think I'll get right down to it here. And I want to ask you some questions. I'm usually on the other side of the questions, so bear with me as an interviewer. But first question is, in your most recent conference call, you provided guidance that suggests Cooper Standard will continue to expand margins in 2025, despite an expected decline in North American light vehicle production and essentially flat revenue. You also mentioned launching new business at higher variable contribution margins than in the past. A few questions here, Jeff. First, is that how you drive the margin expansion? What's driving the higher margin expansion at the VCM, and how much higher can this get?
That's a good question, Tom. And I'll start by talking about the things that we can control, right? I mean, ultimately, I think the industry, we talk a lot about price, but to be fair, with inside Cooper Standard about 4 or 5 years ago, as we were facing what felt like an insurmountable headwind, be it pandemics or be it industry downturn, whatever you want to call it, we really turned our attention internal and started focusing on our fixed costs and really driving fixed costs to an all-time low level as we sat here today. And our teams everywhere in every region went to work on this, because basically what we said is we're either going to make money in every region with each of our 2 products, or we're going to do something else. So it really put a laser-like focus on those fixed costs, which we've taken out consistently over the last 5 years. So that's certainly driven a lot of this margin expansion. The other thing that we did related to variable contribution margin is we reestablished what we felt were our fair hurdle rates when we went into the customer and started bidding on programs really in each region with each customer. We established these hurdle rates, and we found very quickly that with our technology and with our ability to execute as well as we do, that those price points were holding. And so in combination with taking the cost down, controlling what we can control, and at the same time establishing a very clear process internally so that every salesperson and every leader, every plant manager in the world understood what those hurdle rates were. So they were doing their part to take the cost down, and those people that go to the customer to win new business had to make sure that we did it at a price point that was fair for the customer and fair for us. And those were the 2 reasons that you see the margin expansion that you see. So we're really proud of that. I think probably most importantly, it's a sustainable business model. So we'll continue to do our fair share of taking costs out as we improve efficiencies in our plants. There's still a few things that we would like to do around the world, but most of it is where we want it. The last piece related to what we can control is our material cost as a percent of sale. And this year, we're really working with our supply base, working with our engineering teams to provide us different options as it relates to the decisions that we're taking related to material costs for both our fluid and our sealing business. So we're not done yet, but at least certainly the trend is in the right direction.
Fantastic. Fantastic. So let's assume you can drive a variable contribution margin of improvement of around 500 basis points over the next 2 to 3 years as those new contracts kick in and roll over. Assuming an apocalyptic scenario, which is what I like to do as an investor, if you can underwrite the downside, the upside will take care of itself. That U.S. production volumes don't even grow. So first cycle, and by the way, this would be the first cycle peak since the 1970s that didn't peak over 18 million plus units since 1970. And by the way, back then the population was 40% less than it is today. And we'll talk a little bit about that, but this still implies, this is again, apocalyptic scenarios. We stay in the 15s. We're looking at an additional 135 million of EBITDA or total 330 million of EBITDA. So if my math is correct, assuming these apocalyptic volumes in the mid 15s, this business can earn $5 to $6 a share 2 to 3 years out on margin expansion alone. This is a testament to how you've managed the business through this extended cycle trough, which basically was a 1 in 100 year event. I mean, the pandemic and the industry cycle all at the same time. So number one, is this a reasonable way to think about the business? This is kind of my operating model. And if so, say a little more how you did that, because it's just mind-boggling to me that your execution has been so quick and so precise to put us in a position that this is a reality.
Well, thank you. It's very kind. I can't confirm the numbers that you just rattled off there, but I can tell you that directionally you're correct.
Okay.
And then how we accomplish that, I guess, is probably the most important thing. So really, I mentioned it in the first question, but in addition to focusing on taking the cost down and being more consistent about the pricing side as well, we reorganized here last year. So we're about a year and a quarter into this new organization structure where we have 3 businesses now. We have our sealing business, we have our fluid business, and then we have our industrial and specialty product group, which is a much smaller non-automotive business that we have some good growth plans for. But sticking primarily with sealing and fluid for today's discussion, Tom, it allowed us to put 2 presidents in charge, one each of those businesses, one for each of those businesses. We gave them their own dedicated teams, from manufacturing to engineering to purchasing, everything they need within their team to drive the day-to-day performance of those businesses. So it didn't matter what 20 countries were doing business. It didn't matter that 21,000 employees come to work every day, half of them in each business. But what are we going to do? How are we going to get those teams focused, give them the resources, give them the investment dollars that they need to grow the business profitably, but at the same time, hold them accountable for driving VCM, margin expansion, and ultimately returning this business to double-digit EBITDA and double-digit return on invested capital. And that's exactly what we saw happen in 2024, and why our guidance for 25 suggests we're going to return to those double-digit EBITDA numbers for both of those businesses at the end of 25. As we start 26, we clearly will be a double-digit EBITDA and a double-digit return on invested capital company. Okay, that's great. Are you going to slide back down the mountain? No. And why is because the way we have structured these 2 businesses, the leaders that we have in charge, and we're not asking people to do 3 and 4 jobs, right? They can stay focused within the lanes. Our plants pretty much are divided up by sealing and fluid, so there isn't a lot of cross-pollination that ever really occurred in that business. So I'm very, very proud of our plant managers. You've probably heard me say that many times. We have great people in those plants and are doing a fantastic job. And just keep in mind, within Cooper Standard, about 85% of the 21,000 employees that work here every day go to work for our plant managers. So now you know why I wanted the focus to be within those two products, driving the day-to-day execution, and all that's happening. And I didn't even get a chance to talk about innovation, but I'm sure you'll ask me a couple questions as we go forward here, and I'll get into that as well.
Yeah, and it's funny, as I've followed the conference calls along the way and had the chance to meet with you at some of the investor days, I think that people are surprised by two things. Number one, you delivered or are delivering on the double-digit margins in such a short period of time. I think people probably said, I don't know, a couple of years ago, a year and a half ago, when you were talking about that, the fact you could get that done so quickly has been positive. And I think the bigger surprise is I think more people would have guessed that, number one, you couldn't do the double digits, and number two, volumes would have been over 16 million. So on lower volumes, to be able to get that there this year is testament to those employees and those plant managers and yourself as reference. As it relates to volumes, though, I mean, I just continue to look at this, and I know you guys like to be conservative, and I hear you sometimes on that call. I can tell you're super optimistic, and I know you have a little experience in golf, but I like golf. There's something we call sandbagging when guys come in and they say that their handicaps are higher than they are, and then they win all the money at the end of the day. Well, I think that we may have something to be said for that, and that's a good thing, not a bad thing. As it relates to just the industry trends, though, you're going off the industry estimates. I think S&P 15.1 million production. But if you just step back, when these cycles peaked, whether it was in 2005, 2017, 1987, all between 18 and 20 for short periods of the spikes, in the 80s, our population, the census was 226 million people. Now we're at 331 million people. So we're just looking for that 16 to 18 or 17 to 18. But on the basis of population and the age of our population, with so many people being 34, 35 when they buy new cars, I think we could wind up getting surprised dramatically to the upside. But that's just the whipped cream. We're dealing with base case scenarios. So now that we've gone through an apocalyptic scenario, Jeff, let's go through what it looks like for every cycle for the past 40 years when we peak between 17 to 18 million in production. Let's call it 17.5 million round numbers. By my calculation, CPS had approximately $99 in revenue for every vehicle produced in North America in 2024 on a simple average basis. So, round numbers, let's call it 190 a car-ish for servicing half of the total cars, but let's just do it simply, 99 a car. At a more historically normalized 17.5 million peak production, or 2 million more vehicles than last year, you would expect to gain nearly 200 million of additional revenue, considering this is an operating leverage play and your break even is, call it 15 to 15 and a half production, free cash flow positive. With most fixed costs in place, we expect most of the incremental production to go to the bottom line at a higher VCM of approximately 35%. This would be approximately 70 million in incremental profit, or nearly $4 to $5 of additional EPS over our $5 to $6 EPS base case. I mean, round numbers at peak cycle production, if it's 17 and a half, $9, $10 a share in EPS base case from our side. Not, I know the position you're in. Is this a reasonable, not guaranteed in any way, or any guidance way to think about it? In other words, if you were to say, Tom, look, I can't guarantee that, but your argument is flawed here, here, and here. Can you legitimately say my argument is flawed in that way of thinking about it if volumes normalize the way they have going back every single cycle for the last 40 years, and also not even accounting for the fact that the population was 32% lower in the 1980s?
Yeah, first, I agree with your premise. So let's say it that way in terms of the demand. We believe that there is upside for many of the reasons that you talked about. I usually don't permit that discussion in this room because obviously we don't control it. So we tend to focus our attention on what we can control and not get too excited about what the volumes could be based on the type of data that you just recited. But clearly, Tom, we believe that there's pent up demand. We also believe in many of the reasons that you just described that this is just around the corner. But most folks that get paid to forecast automotive volume don't usually do that in advance. At least that's my experience over 40 years, I guess, is that we tend to see them forecasting increases after the increases have started. Now, it doesn't work that way when it's going the other side, so I'm not sure why. But anyway, that's kind of how it goes. Your estimate for VCM is also in the right range. So we certainly are planning for an increase in volume. We just don't know when that's going to come. But you mentioned guidance. So when I talked about the guidance here in the last earnings call for 25, I mean, we were certainly conservative in terms of this conversation, right? We used the numbers typically all suppliers use S&P to help gauge what the next 12 months is going to be, and even what the next 2 or 3 years is going to be. And while there's some increases out there forecasted, they're certainly not the level that you and I are hoping for or discussing with this particular question. But I'm sure that increases are going to be coming. I just don't know when. But I also will say that the numbers that we talked about on that last earnings call in terms of what you're going to expect to see from our increasing EBITDA each year, even on these suppressed volumes, and our return on invested capital with these suppressed volumes, it's very exciting because we're able to make money, and we'll be generating more and more cash each year without the increase in volumes. So when they do come, we're pretty excited about what that means for our company and how much stronger it will be for the next couple decades as a result. So it's very exciting to think about. I just don't really allow it to distract us because there's not much I can do about it.
Yeah, in my business, we say you take care of you protect the downside, the upside will take care of itself, and that's what you've done through the execution and right sizing the ship to be ready for good things coming forward. So we appreciate that. 3 key reasons I invested with you in May of 2022, and I remember we had a talk in August when we had a chance to meet that time, and I've continued to add a significant amount of shares across accounts and personally. Is number one, I want to acknowledge your respect for equity. There are actually less shares outstanding today than in 2017, about 17.56 million versus 17.69 on December 31st, 2017. Second reason was part of your compensation is tied to return on invested capital. That's a very important metric for me. And 3, you own a lot of stock. You're a partner. You know, we're investing right alongside with you, and you have skin in the game, which is very important to us. Can you speak to your and the board? You are the chairman, but the boards as well. Philosophy on all 3 of these concepts and why this culture is critical to owners as the cycle returns.
Thanks. I think first of all, the board, the management team, we have a responsibility to behave in the best interest of all of our stakeholders, of course, but none more important than the shareholders. So I am very proud, and you probably have seen the recent insider buying activity that's gone on. I'll just say it. Our lead director and our chief financial officer here in the past month have added to their shares. I own 2% of the company, sitting here as the chairman and CEO of Cooper Standard. So I can assure you that it's in our own self-interest, but it's also our responsibility, and we take it very serious. And I agree with you that most investors talk to me about that. They want to understand the ownership and the requirements and how we're paid and what the long-term incentive plans are versus the annual incentive plans. And I think we've always prided ourselves all the way back to 2012 to today that those metrics and the way we're measured and in the compensation for the management team aligns with shareholder expectations and values. And obviously, the last 5 or 6 years have been extremely challenging for a lot of reasons. But at the end of the day, I'm proud of the company. I'm proud to be a significant owner in the company, and I will continue to make sure that we uphold that standard.
Yeah, well, thank you for that. And for those of you, just round numbers to put it in English, 2% of the company is, give or take 350,000 shares. That is a serious partner right there. We have more than that, and we're excited to be a partner right alongside you. But please, that's material. So next is we've typically pointed to new vehicle incentives as a leading indicator for SAR. After incentives as a percentage of the average transaction price bottomed out in September 2022 at 2.1%, we've seen a strong recovery back to 7.2%, although that's still below the 9.8% average of the past 2 decades. In English, for those of you who are listening, if it's, call it 10% of a $50,000 car, they would be giving 5,000 incentives to get you down to the dealership to buy one. With new vehicle prices seeing a significant jump over the past few years and an all-time record gap now between new and used average total prices, could you comment on the role of incentives as a potential catalyst for new vehicle sales and improving profitability? And could you also share your thoughts on the relationship between incentives and overall production volumes?
Sure, I'd be happy to, and it's something that we track, so it's easy for me to tell you what we think there. First of all, the constraints on production that really resulted from the pandemic and the supply chain disruptions that followed. I mean, I sure hope it's a once in a lifetime event. I can assure you, it's the first time I've seen anything like this in the 40 years that I've been part of this industry. So I think that as we move through it, that's exactly what it'll be. It'll be history, and I don't think it's going to repeat itself anytime soon. But I do believe that as inventories get reestablished and as supply chains smooth out and become normalized again, that there's just so many great vehicles. And you think about the 3 powertrains today, whether it's the ICE engine, whether it's the battery electric vehicle, or whether you like something in between with plug-in hybrids, there's great vehicles out there. And I think the competition has never been better. And so for consumers, I think that pent-up demand that you and I discussed earlier, it's a reality. And what I've also seen over the course of a few decades in the business is when that competition heats up, incentives do start to build. In fact, we track that as part of a leading indicator within our company, so that we maintain. You get the releases from the customers, which is what we go to the bank with, so to speak. But incentives, as you see them increasing across the board, you typically see volume increase as well, because dealers are moving the product. The product is outstanding. It's world class. About anything you want, you can go get. I do believe that we've seen incentives increase last year. We'll see them increase this year, and as a result, you'll see vehicles moving off of dealers' lots at a faster pace, and as a result, you'll see production volumes increase to support that. That's what I believe.
Thank you. And God forbid we actually get President Trump was talking about tax deductibility of interest on auto loans. That would be an additional kicker, which is pretty wild. This past quarter, you announced that the fluid handling segment sales are expected to increase by more than 50% over the next 5 years, with the segment's weighted average CPV, cost per vehicle, expected to go up by more than 30%. I know the sealing systems business is pretty similar in terms of CPV across different powertrains, but could you share your thoughts on the outlook for the sealing business and what kind of opportunities you see over the same time frame? Is that 30% CPV increase on the fluid handling baked into the margin expansion we discussed?
Yeah, so for sealing, it's an interesting dynamic there, no pun intended, because part of the sealing business is called dynamic seals and the other part is called static seals. I won't bore you with which is which, but in many cases, the automakers don't source all of the static and all of the dynamic to the same sealing company. So in certain vehicles, there's more than one sealing company providing those products. So to answer your question, yes, there's an opportunity for us to considerably increase whether it's dynamic seal or whether it's static seal, depending on which one we happen to have on a vehicle. And what would cause that? Well, our innovation would cause that, because we have now just announced recently that we have innovation for our new static sealing system, our dynamic sealing system, that would provide customers with the opportunity to source us for a product that would reduce their weight by 40%.
Wow.
And it's also more recyclable than anything that they have in the marketplace. So a 40% weight reduction for a particular sealing system, I think, will help differentiate that business. So let's see. We've already been sourced on one major EV program. It's just out this year. I mentioned it in the last earnings call, so I'm very excited about that. So how do we get more sealing business, innovate, provide our customers solutions that they can only get from us, helps drive their costs down, helps them meet their metrics as well as it relates to lightweighting. I believe our sealing team will benefit from that all over the world. And I know the Chinese OEMs are looking at it right now in a big way. Related to our fluid business, I mentioned that there's two things going on there. If I just use ICE vehicles as a baseline for our fluid business, if we have an all-electric vehicle, because of the complexity and the content, that content per vehicle actually goes up about 20%. If you look at a ICE vehicle versus a hybrid electric vehicle, the content of our fluid business goes up 80%. So yes, we are rooting for more hybrids to hit the market. Fortunately, that is going to be the case, especially here in the North American market. And I know many people talk about the electric vehicle in China and how the perception is that it's just all electric. But I will tell you that about half of the vehicles that are being produced over there today, and it's a very, very important fact for Cooper Standard, it's plug-in hybrid. So in addition to battery electric vehicles, they also have plug-in hybrids. So our fluid business, in a market where 30 million units are being produced as we speak, the opportunity to grow our China business is huge. And they love our products, and we're doing quite well. We've returned to a 10% EBITDA already with our China business.
Wow.
Despite the fact that the Western OEMs are losing share, and that was a big part of our company in China. In fact, we were probably 90% of our revenue was Western OEs just 4 years ago. And obviously their volumes have come way down. If I fast forward to 2026, we will have replaced all of that revenue that we've lost with Chinese domestics, and we'll have increased it by over $100 million. So our Chinese business is doing extremely well. Fluid is a big part of that, but also our sealing business. We're doing quite well in that region with our sealing business too. So small fact related to plug-in hybrids in the Chinese market that not many people talk about, but it is a fact. And it's interesting because the North American market, as you well know, was predicted or at least forecasted to go much faster related to EVs. And, there was the numbers out there, 30% by 2030, which would have still been good for Cooper Standard. I think that's slowed down a little bit. I think it's still a fast growing market. that hybrid very quickly with every customer here in the North American market, they are launching plans for hybrid vehicles. So again, our content goes up by 80% if a hybrid rolls off the end of the line. So it's a pretty cool fact.
Yeah, that's absolutely amazing, Jeff. I think when I originally underwrote the investment in 2022, I had China at $0, and I think I had hybrids and EVs not even factored into our internal models here. So all of this
one question I guess I didn't answer the portion of the question that you said, is that factored in what I just said for 25, 26, and 27, and it is not.
Wow.
So that would be upside to that because the customers hadn't announced all these hybrids yet. They're just talking about hybrids are coming, and we really didn't have enough detail by customer as to what that meant and when they were going to be launching. So these are the facts that will have that type of an increase in content per vehicle, but it was too early to model it in any of these financial numbers. So as we book this business, then we will update our forecasts accordingly. And I think last year, about 40% of the business that we booked was on hybrid vehicles. So it's coming fast.
Wow. Well, that is super exciting. Just for those of you who haven't been following for some time since 2022, Cooper Standard in 2017 at the peak traded at $146 a share and earned about $7.19 a share. So it traded about a 20 times multiple. We've talked about our internal estimates with Jeff here of what we think the company can do on normalized volumes. So whether the market assigns us a 20 times multiple again on that bigger number we discussed earlier, or a 10 times multiple, the key is we think at Great Hill Capital, and Tom Hayes, opinion, not advice, consult with your financial advisor. The upside is phenomenal, and we just keep getting more information, and things look more and more positive. All the things that we had underwritten to zero are now showing huge upside growth potential, and we're pretty exciting. Over the past 2 years, Jeff, it looks like CapEx as a percentage of sales has been much lower, maybe 2 to 3% range compared to historically 5 to 6%. Given all the new business wins, do you see CapEx staying in this lower range moving forward or renormalizing?
Yeah, we've done a nice job of managing CapEx through this period of time, and while I think it's probably unrealistic, I think we finished at 1.8% in 24. That was a lot to do with the timing of the launches of new programs and things like that. I would say consider 3 to 3.5%. I think that's probably where we'll end up being quote unquote in a normal range. And keep in mind, a lot of that has been driven by just terrific work from our manufacturing engineering and product engineering folks. I mean, probably 5-6 years ago, they started on this track to make sure that we are able to reuse the capital much more than we have in the past. They came up with standardized designs, so we didn't need as much capital variation as we did in the past. Worked with our customers to get the specifications that we needed to really help on the capital side of the business. So from all of our engineers to our customers' engineers, this has really been a success story. And in the days of us having to spend 5 or 6% on capital expenditures are gone. Wow. 3 to 3.5, I think, is probably the more normal number going forward.
That's amazing execution, all I can say. A couple more here. After the announcement of the 1-month reprieve from the 25% tariffs for U.S. automakers, there's been talk that many automakers might start racing to build out inventories as quickly as possible. Is the industry expecting to see this trend play out, and what's your take on it?
Yeah, I think it's interesting, and certainly the volumes here in the first quarter, I think the strong volumes in the first quarter probably are reflecting some of that sentiment, I guess. I really don't know. I tend to not get out ahead of my blockers and have these conversations. The blockers here are the customers, and the OEMs are dealing with this directly. But as it relates to the supply base and the industry in general, I guess if you've been part of it for 40 years, it's okay to talk about it in its fullest context. I really believe that there's good intention, I think, being discussed in Washington related to tariffs and the industry. But I do think that given the way the supply chain and given the way the OEMs have established the infrastructure and the overall business model, I would be very, very destructive in the short, medium, and probably everything but the longest term you could think of to go this way. So I tend to think that if that's the case, and nobody's looking for it to be that destructive, that it probably isn't going to be as long or drawn out as maybe it would need to be in order for it to be productive. So given that situation, I'm hopeful that cooler heads will prevail and we'll manage through this in a way that doesn't disrupt the momentum really that the industry has built here. And we're talking about pent up demand. We're talking about great vehicles ready for market. We're talking about consumers that for the first time, hopefully, are going to be in a geopolitical environment that gives them hope. And secondly, in an overall economic environment that talks about lower interest rates and talks about GDP and talks about inflation in positive terms. And this again will create the desire for consumers to go out and take advantage of the great vehicles that are available. And I would just really hesitate to think that there would be a policy coming out of our government that would destroy that value and destroy that particular situation for the auto industry. It takes too long to make the moves that some folks think can be made by applying these tariffs. This is just my opinion. I'm just a small supplier here in Northville, Michigan, so I probably don't catch the drift of the whole thing. But that's my personal opinion on it, Tom.
Yeah, and the question is whether people are going to spend tens of billions of dollars to stand up factories in Mississippi for 3.5 years when the factories won't even be built by the time the rules change again. But that's another story we could talk about. Looking at the current industry outlook, North American light vehicle production is expected to come in at 15.1 million, with SAR projected between 16.0 to 16.3. And I got to say, when that press release came out for Q1, I was like, wait a second. I had the SAR and production numbers overlaid for 20-something years, and it's basically the same line. I'm like, how did I get this million gap sandbagging me on this call? But anyway, there have been instances. They're not very common, Jeff, I just want to say. But if these forecasts hold, it would be one of the largest production deficits we've seen in quite some time, with the only other times being coming out of the pandemic and before that, the 2008 financial crisis. Every time we've had a deficit of over 1 million units, again, very rare, Jeff. Production has usually had a hockey stick style recovery in the following years. What are your thoughts on this kind of production catch up, and what sort of implications do you expect if current forecasts hold true?
Yeah, well, as I said a couple times, I believe we'll see a ramp up in production volume. I just wish I could predict when, but I think it's sooner than later. I agree with your statement. And we've certainly changed our strategy, right? I talked about how we changed the entire organization structure of the company. We've certainly gone all in as it relates to our capital strategy and to driving innovation, investing in innovation, and providing customers with solutions that otherwise they wouldn't have had. So we believe that it's here. We believe that we'll see it. We believe that our products will be in a greater demand, and certainly any incremental production volume over the period of the next few years is just going to make things that much better for us and for all suppliers, because we all know that as volumes go up, suppliers do a whole lot better. I think all of us have done a very good job of weathering the storm. We've all managed. Nobody's sitting over in the corner whining about what's happened the last 6 years. We've focused on what we can control. We've managed our business, and I think the supply base is strong as a result of it. But we're not going to be able to absorb tariffs. We're not going to be able to absorb material economics. We're not going to be able to do those things. But clearly, we're going to be able to run our factories very efficiently, and we'll be able to provide great products and great services to our customers. And I think that's proven for us to be the winner, right? We launch great, we execute well, and our customers continue to give us more business. They all vote with purchase orders, Tom. That's just how it works.
Yeah.
And over the last 2 or 3 years, I mean, we're almost at record highs in terms of booking new business. So we're really proud of that.
Yeah, no, it's phenomenal. Last couple here, and then we'll do a couple fun ones and wrap it up. As you return to double-digit margins and return on invested capital and continue to generate strong cash flows, you mentioned not only the expectation of having various options to manage upcoming debt and improve the cost of capital, but also the goal of reaching 2 times leverage by the end of 2027 without even contemplating a refi. Since there are no major refinancings needed till 2027 and a de minimis $43 million in November 2026, do you need to address the capital structure this year? And assuming a bump in production from the front-loading production in March or the first quarter and a modest continued moderation in rates, is there a view to possibly wait for a credit upgrade or some other event before taking that action?
That's a great question. And certainly you're right. We don't have an urgent requirement to deal with it right now. I think if I would put a time frame on it and I had my magic wand, sometime between this summer and next year's first quarter would be ideal. And why do I say that? Because that gives us an opportunity quarter by quarter to continue to put points on the scoreboard, continue to show the improvement is sustainable within the business, continue to improve the EBITDA, and continue to improve the return on invested capital, continue to generate better cash flow. And at the same time, I truly believe that the geopolitical environment in turning down the temperature of the world is going to occur during this same period of time. And I also believe that we'll continue to see strong economic metrics that will allow the interest rates to continue to come down. And at the same time, you mentioned the two times leverage. Well, that's a journey from where we are today to 2 times, but there's a couple other pretty important points along that journey, right? If we got to 4 times, that's better than where we are today. And that would result in a significant improvement, probably in the rates that we would be able to talk to the institutions about. And certainly they will have visibility into that 2 times or better journey that we've been very openly discussing. And then, as we've discussed, if that is built on top of volume improvements, then it's just going to make it that much better. But I think we've done a really good job of getting ourselves in a position to be able to be patient over the course of the next year or so, and hopefully find ourselves in a better overall economic environment. And then the company will have probably, to your point, received an upgrade along that journey, and then that might be the better time to pull it. And I think that's probably how we're thinking about it. We certainly, at the same time, we don't want to let the existing long-term debt become current debt either. So
exactly.
There's an incentive on both sides of this, and the relationships we have with the banks and the ability to do what we've said we were going to do for all these many quarters and many years, I think will also help in the conversation.
Yeah, and I think what's implicit, what I was getting to in English for our viewers and investors, is implicit in that 2 times over time is effectively the operating leverage in the business. This thing, as volumes normalize, can print more money than the U.S. Treasury. You don't have to comment on that one. The last thing is on everyone's mind. If a good portion of your production is in Mexico due to the fact that that's where the OEM factories are and that's where they wanted you to be, Are you mostly shipping your products to the OEM plants in Mexico and not across the border, i.e., as it stands, you wouldn't really be impacted by tariffs if that is the case? And how much impact do you expect from proposed tariffs if, in fact, they go through as advertised? And if there is any material exposure, how do you expect to manage it?
Yeah, well, we certainly do ship a lot of our product back across the border from Mexico. A lot of it is used in Mexico as well. So let's just say it's probably a little bit over half, though, that comes back at the request of our customers here in the U.S. So it's significant to us. I think that's probably the good news, that it's significant to us and it's significant to the entire industry. So it isn't a sustainable situation, and we obviously anticipate, and so we've been providing our customers all along with this information. So it's not a surprise. Every single OEM that we're dealing with here in the United States is very aware of what the impact would be to each and every supplier and their vehicles as well. And they're having conversations with us about how do you deal with it. And so there isn't any way that a supplier can deal with a 25% tariff on half the product that's coming from Mexico to the U.S. So in our case, like most, there would have to be a conversation and a way that the OEMs are going to absorb it in order for it to be sustainable for the industry. But it's so large and ultimately would all be passed on to the consumer at the end of the day. And that gets into that conversation you and I had about, wow, then you would be really destroying value. This isn't sustainable. It doesn't work even for a minute, let alone a month. So I'm hoping that between now and April 2nd, this gets figured out and we don't have this distraction as an industry to deal with, because it wouldn't be fun.
Yeah, makes perfect sense. Since I know Cooper Standard, a couple fun ones here. Since I know Cooper Standard is doing a lot with AI these days, the final two bonus questions are AI generated compliments of Grok, which is Elon Musk's AI. You know, it's funny, people, when NVIDIA was trading at $152, everyone said, "What are you doing for AI?" I said, I'm doing this company called Comstock Resources. They're a natural gas play, and it was $8 and change. Now it's up close to $20. And then people were like, "No, really, what are you doing about AI?" I was like, "Well, I'm doing this thing called Alibaba. It was well under $100. Now it's 145, going to 200. It may be that Cooper Standard is going to be the AI play of 2025 with everything going on. But leaving that aside, here's the first question from Grok. Suggested that I asked you again. All of this is opinion, not advice. This is not recommendations. Talk to your financial advisor. This is not guidance. This is a conversation. So here's what Grok says. Jeff, if you were an investor, or if you were an investor with $1 million to deploy, why would you put it all into Cooper Standard stock right now? Now, we would never recommend anyone puts 100% of anything into one stock, but that's the question. So give us some guidelines here, Jeff.
Yeah, as I mentioned in the conversation, Tom, I mean, because we've taken care of our own business, right? Over the last 5 years, we've established a cost base that allows the company to flourish. We've already put enough points on the scoreboard to tell you that by the end of 2025, we're going to be at double-digit EBITDA, and we're going to be at double-digit return on invested capital. And then when we forecast and just look out a few years from that point, we've said that our net leverage is going to be 2 times or less. All of those statements are on the volumes that exist today and a very slight increase in forecast over the course of the next 3 years. So if I would look at that and I would be an investor, I would say, wow, there's a company that's delivering results. There's a company that has told us that they're going to return to the type of prosperity that existed back in the 2017 period of time that you mentioned earlier was $140 stock price. I'm not predicting that. I'm just telling you that I know what that feels like, and I know what it feels like today, and I know what the industry pent-up demand is for the next 3 or 4 years. So with that, it's pretty tough to find I think, a company and an industry that's better positioned than what we are.
Love it. And this one is also from Grok, and it's interesting that they mentioned Warren Buffett because I look up to him a lot. A lot of our framework is similar. If you had to pitch Cooper Standard to Warren Buffett, what's the number one metric you'd flaunt to prove this is a cash machine worth owning?
I think we talked about this. I own over 350,000 shares of Cooper Standard stock.
Yeah.
That's about 2% of the company. So that's, I think, putting my money where my mouth is, and it also, for me, is probably the most important metric. And I could talk to you about all the other company metrics, but I'll just stick to that personal one.
I love it. I love it. And final question, Jeff, is there anything else we didn't cover that you'd like to share with our audience of investors today?
I think we've covered it all. I'm excited about the future. I'm excited about Cooper Standard. I mean, we have great employees. We've talked a lot about our product. We haven't talked much about our culture today, but it isn't just the what we make, it's how we do it. And I'm so proud of the 21,000 employees that call this home, and we don't have a lot of turnover. We have great people. It's not the sign on the building that makes us, Tom. It's the people within the buildings, and I'm really proud of that fact. So that's how I would end it. Thank you very much for the conversation.
Well, thank you so much for joining us. Very grateful for you taking the time. That's Chairman and CEO of Cooper Standard, Jeff Edwards. And we're back. So comment below at YouTube with your number one takeaway of the interview with Jeff Edwards and the top 10 takeaways. We will get you out one of these incredible hats. So moving along, want to thank Jake Mack and Taylor Riggs for having me on the Clayman Countdown Fox Business this week. We got to discuss two of my favorite companies, Alibaba and Lip Boo Tan for Intel. Listen in here.
But are markets, at least today, looking through the data and focusing on the fundamentals of some of these companies, which do indeed remain strong? Joining us now, I'm pleased to say, Regions Chief Investment Officer Alan McKnight and Great Hill Capital Chairman Thomas Hayes. Alan, let me start with you, because today it does feel like that push-pull where you get economic data, but then you're looking at the Fed or the tariff put and thinking maybe this is actually good news for the market. What do you think?
I think it is. And I think what we're seeing today is that markets may have been oversold a bit as we went through last week, and it was just the absence of information. So now with a little bit more information, when you think, okay, retail sales was maybe not as good, but not horrible, when you hear some of the commentary coming out from various companies, I think it gives a little confidence to investors to realize that it's not as bad as everyone anticipated. And the old Rudyard Kipling, if you can keep your head about you when others are losing theirs, that's what we're getting today.
Tom, weigh in here, because everything that I've heard is there's going to be a lot of uncertainty until April 2nd, but then we're getting clarity around reciprocal tariffs. We may bottom out later on mid-year, and then we rally into the end of the year. How do you think about this uncertainty?
Well, Taylor, I think Warren Buffett said it best: be greedy when others are fearful. And every single fear indicator is completely washed out. The AAI sentiment showed just 19% of retail investors were bullish last week. They bought record puts after the market was down. You want to buy that house insurance before the fire. And hedge funds were record selling stocks in the whole. These are all contrarian indicators, and this is when we look for opportunities. We're seeing the Fed put back in play for June, 82% chance of a cut in June.
And talking about some of the fear gauge, you're looking at the VIX, which is down with a 20 handle, which sort of reflects the calmness, at least today, that we see in the market. So, Alan, I want to know what's on your shopping list, because I think a lot of people last week were getting a little nervous, like, oh my gosh, is the bottom here? Is there more room to run? But on the other hand, people are like, look, everything is 10% on sale now. And if I liked a sweater at 100, I like it even more at 90. What's sort of on your shopping list?
Well, by the way, I like to reinforce that with my three daughters. I wish they would follow it more often. But the bottom line is that we still think communication services, we think utilities look cheap here, and it's all about the earnings. And I think we're going to see, as we get into first quarter earnings season, if you can continue to buy companies that are delivering earnings in excess of 10, 15% growth, it pays to go shopping when things are on sale. And we're
Is
seeing that.
utilities an AI play still?
It is. And I think that's where utilities is now a growth name. And if you had told me 10 years ago I would buy utilities for the growth, I would have said you're crazy. But today you look at the type of growth they can generate because of data center growth, because of AI that is fueling that data center growth. And suddenly you're really seeing an opportunity there, particularly in the southeast part of the country where you're seeing continued population demand as well.
Tom, I'm not calling you crazy, but a lot of people might call you crazy when I look, and one of your top picks right now is Intel. This is a great storied American company. They just announced, I believe, on Friday, a new CEO, but this is a company that has struggled. Why Intel, and why Intel at $25?
Well, Taylor, Lip-Bu Tan is the new CEO. He came from Cadence Designs when the stock was down 86% in 2009. If you had invested $1 million when he became CEO, by the time he stepped down 14 years later in 2023, that $1 million became $68 million. Lip-Bu Tan is a miracle worker, and Intel needs a miracle, and I think they're going to get it. You know, the key thing here is NVIDIA's growth rate has decelerated, not for lack of demand, but for lack of supply. TSMC is at capacity. Intel in the background has been building up the fabs. They're ready for prime time. NVIDIA is testing chips. Broadcom is testing chips. And Lip-Bu Tan is going to spike the football in the end zone. We're very excited about Intel. And it's trading just a couple bucks over tangible book value. So if they liquidated the whole company today, you get most of your money back. And if he does what he could do, which we know he can, it could be a double and beyond in the next 12 to 24 months.
But Tom, a lot of people are thinking that Intel, I mean, I've heard, not rumors, but, words used like they're selling the car for parts, right? Where you had rumors about Broadcom, TSMC coming in, looking at different portions of the business. Do you like it as a sum of the whole, or do you like it as different parts?
Look, if they sell it off for parts, we probably get 35, 40 bucks when all is said and done. Lip-Bu Tan has stated he's going to run this business. He's not interested in a fire sale. He's going to turn this into a multi-bagger. Everything is there. Actually, Gelsinger did lay the foundry framework to move ahead and to supply the NVIDIAs and the Broadcoms of the world. Lip-Bu Tan is going to finish that execution at the 5-yard line, take it in for a touchdown. This is going to be, look, it was on no one's bingo card at the beginning of this year that NVIDIA would be among the worst chip producers this year in terms of performers. And Intel is now the top performing semiconductor company for year to date 2025.
Okay, I think people might say that says more about NVIDIA than it does about Intel. We'll see. But Tom, I do like the bull call. Alan, you talked in break with me about just diversification is winning right now. Fixed income, international. And this sort of plays into what we heard from Scott Besson over the weekend about how ignore some of the volatility. It'll all work out. Take a listen to what he had to say.
I can tell you that corrections are healthy, they're normal. What's not healthy is straight up, that you get these euphoric markets. That's how you get a financial crisis. It would have been much healthier if someone had put the brakes on in 06, 07. We are going to have a transition, and we are not going to have a crisis.
So again, corrections are healthy, but if the diversification for you is what's key within navigating the correction.
That's exactly right. Secretary Besson is spot on in this idea that it's very normal for markets to go down. So if you look over history over the last 100 years, you should expect a 10% correction every year and 5% corrections every year. So it's not abnormal. It's just that we've had these two excessive years of 23 and 24 where everything worked. It's going to grind a little more this year as investors start to understand what's happening. And the only free lunch investing is diversification. So international has performed better. Fixed income has performed better. So a fully diversified portfolio actually looks very good right now. And then to your point earlier about buying some things on sale, you can now actually rebalance a little bit to pick up some of these domestic names.
Tom, final thoughts to you.
Yeah, look, we continue to like China. And people said we were crazy when we were buying Alibaba in the 90s, in the 80s, in the 60s. Now it's over 145, going to over 200 over the next 12 to 24 months. I'm telling you, Intel is going to be the exact same way, Taylor. They're calling me crazy now. When it's at 40, 50, 60, they're going to say, wow, is it time to buy at 60? And I'm going to say, yeah, it's probably going higher. Lip Bhutan is a miracle worker.
Why don't we make crazy good again? Sometimes my husband calls me a little crazy. And look, I didn't turn out so bad. So maybe a little crazy isn't so bad. Really appreciate both of you, Ellen McKnight and Thomas Hayes. Please come back and join me.
Thank you, Taylor. And we're back. And then I got to join three incredible people on the Money Show podcast this week. I want to thank Mike Larson for having me on. As always, my buddy Kenny Polcari and Jim Bianco, who is a bond expert and macroeconomic expert. It was great to be on with the three of them. We don't have time to go through the whole half hour, so I cut out my clips, which is a broad overview of the markets, so we can get through that.
Accord is how you put it in just a minute, but I want to go to Tom first. Tom, I know you're big bottoms-up analysis, valuation of individual companies, but you got to look at the big picture here too. What are your thoughts on just how things have changed since the first of the year till now?
Well, I think this is pretty standard, Mike. This is what we see pretty much every 4 years. Post-election year, you see some weakness in February through mid-March, and then you start to find a bottom. And why is that pretty uniform going back, 100-something years is because people want to get a sense of what the policy is. And it doesn't have to be good policy. It just needs to be known policy. And I think that's what we're grappling with Trump right now. But I say to many people, welcome to Trump 2.0, same as Trump 1.0, new day, new headline, new tweet, new volatility resolves higher over time. And what we saw last week is a big flush out, record selling by hedge funds. That's a contrarian indicator. A lot of momentum followers there, over leverage. Retail investors bought record insurance, record put buying after the house was already burned down. You want to buy those insurance premiums before the fire starts. So you can't make that up. Then you had the largest drop in U.S. equity allocation on record in the Bank of America Fund Manager Survey, which we saw this week. So I think we're finding a situation where we can go in and buy stocks. As for the Mag 7, at your events towards the end of the year, I was saying the theme was going to be a shift out of the Mag 7 into the unmagnificent 493 and more importantly into international. That's played out as anticipated. We think that theme will continue. And Mag 7, you got to look at two things. Number one thing no one's paying attention to that I've seen is the Japanese carry trade unwind, okay? And all you need to do is look at 10-year JGBs, and what you see, what used to be free, hot money, and now has a cost. 10-year JGB yields are at 20-year highs. Those have continued to creep up aggressively in the last 4 weeks. And as a result, the most impacted part of the market has been the Mag 7, where all that hot money has been parked. So I do think that, yes, we are due for a technical bounce. Maybe Mag 7 will trade back up to the top of the range, but I think the theme for 2025 will continue. Mag 7 will underperform relative to 493 and dramatically underperform relative to international, as we've seen.
Yep. Thanks, Tom. Let me riff a little bit. I mean, you've talked international. You mentioned Alibaba. Is there anything else that particularly excites you now? I know you've talked about some names at our past events, but we're getting towards the end of Q1, so I figured I'd see if there's anything new that's on your radar screen.
Look, I think Intel is the most underrated story. If they liquidated the whole damn thing today, you'd probably get about 22, 23 bucks. It's trading at 25. Lip Bhutan was at Cadence Designs, which makes the software for all of these chip designers. Lip Bhutan became CEO of Cadence Designs in January 2009 after the stock was down 86%. If you'd put $1 million with this guy, by the time he stepped down as executive chairman 14 years later in 2023, that $1 million became $68 million. 68 bagger. This guy is a miracle worker. Intel needs a miracle. He's going to deliver, and he's not interested in partnerships or selling it off for parts. He's going to run this thing up the flagpole. And here's the thing. NVIDIA is not down because of lack of demand. NVIDIA is down because of lack of supply. TSMC is at capacity and only gives them $4 billion of revenue growth per quarter, which on a bigger base decelerates the revenue growth from 250% down to probably 30-40% by the end of this year. They need capacity. TSMC could say, yes, Mr. Trump, we're going to invest $1 trillion in the United States. The problem is it's going to take them 4 to 5 years to get to where Intel is with their fabs today. So love Gelsinger or hate him, he did one thing over the last 4 years. He set Intel up for success, and Lip Bhutan is going to come in and spike the football in the end zone as this chip production comes on board. Right now, NVIDIA and Broadcom are testing their chip in Intel's U.S. fabs. And from what we have gotten back through media, it's going quite well. This game is just beginning for Intel, for everyone saying, oh, Intel's going out of business. I mean, give me a break. They've done over $50 billion of revenue in the last 12 months, being completely mismanaged. And now you got someone who can ride this horse to the promised land, and we're getting on with them.
And as an old school person, all I can do is reminisce about the Wintel days, right? Why don't we only have a couple minutes left? I want to make sure, for anybody watching, Jim is going to be joining us in Dallas and Miami. Tom and Kenny are going to be joining us at the Miami Symposium in May. Guys, if you have maybe 30, 45 seconds to just give a preview of what you think you're going to be talking about. Tom, maybe I'll go to you first and let you do that now.
Yeah, I think one of my segments is going to be how the uninvestable became investable. While we were building up our BABA position, everyone said it's uninvestable, it's uninvestable, it's uninvestable. We're going to talk about kind of market sentiment that goes into that, how you can see through the noise, look under the cover, follow the fundamentals. In the short term, the market is a voting machine based on emotions like you saw in the last 2 years in China. In the long term, it's a weighing machine based on fundamentals like you're seeing right now. And then we're going to talk about some, in the second segment, some year-end picks, year-end outlook, a lot of opportunities to make money in the second half of this year. So we're really excited to go down to Miami and deliver a lot of value. And we're back. And this is the event that Mike and I referenced in the Money Show interview. I'll be speaking at the Money Show in Miami. The event is from the 15th through the 17th. My 2 segments are on Saturday, the 17th, before I fly to go see my friends in Dubai. Looking forward to that. So you can register either at the Money Show website, miamimms.com, or go to hedgefundtips.com and just put Miami in the search bar, and this will come up and you can register there. Then I had a chance to join Diego on CGTN America. I want to thank Diego and Camelia Kilowan for having me on. This was about Tesla and Elon Musk. You can go ahead and watch that at hedgefundtips.com. And I want to thank Yahoo Naomi Buchanan for including me in her article on Yahoo Finance about the carry trade. And now our quotes of the week. There has never been a more appropriate quote for what is happening right now. It's kind of funny because so many people are coming up to me complaining about the stock market at the country club and everything else. And they're like, when's this going to stop? I'm like, what going to stop? Like, I mean, we've just had an exciting period of time between what's going on with Alibaba and some of the others. And, it's interesting as it relates to Cooper Standard. And I had a number of comments, today, like they really enjoyed the CEO interview and everything else. And I said, look, $2 down or $2 up really doesn't matter. The key is how we're positioned for the long-term story. And Cooper Standard couldn't be better positioned. And nothing has changed either really in the information, although the information's gotten a little bit better than our original thesis, than when we originally got involved in May of 2022. It's just now all the things that we said were going to happen when no one believed it are now starting to happen, and people are starting to get excited. And I think it's literally the early days of the early days. And when this thing turns, it turns all at once. Just like we saw with Alibaba, it takes years, then it happens all at once, just like we saw with many others throughout the years of this podcast. So this is a very important thing. I think Buffett likes to say, the guy enjoying the shade today planted the seeds many years ago to create that tree. And that's what we try and do. And we are very methodical about burdening ourselves with the facts. And then once we know what we own, not getting deterred by short-term noise, whether it's $5 up or $5 down, it's completely immaterial. We know the intrinsic value, the price at which we are willing to be a seller before we even enter the investment, before we even enter the position. And I can assure you, with Cooper Standard, we are nowhere near that price. It's anyway, if you, I'll be very interested to see the takeaways in the comment section and who wins it, because if you listen very carefully to what this business can do, both with apocalyptic scenario volumes and, God forbid, normalized volumes, it's pretty exciting. Anyway, Charlie Munger, people calculate too much and think too little. I think that's certainly the case. I have people saying, well, what if this happens and what if that happens? Look, I don't have a crystal ball about policy and all this stuff. It will be a short-term bump in the road. At the end of the day, there's a population, there is a useful life in an automobile, and all of those things require massive amounts of automobiles. And I actually think this cycle is going to peak well above 18 just because of the size of the population relative to previous cycle peaks. Number one, the age of the fleet, which is the oldest it's ever been, and some of the initiatives that this administration are putting in place as it relates to lowering rates. And we're going to talk about that a little bit, what Bessent is doing, and potentially making loans on interest payments tax deductible, as well as incentives starting to pick up massively, and they're only going to go higher. So a couple charts some data we want to cover this week. First and foremost, average S&P returns following 21 corrections of 10% since 1980. So when there has been no recession, which was 14 out of the 21 times, which we believe this will be the case this time, 12 months later, you're up 11% on average. And then want to cover some of the Slumer insights here. You could see here, I mean, look, there's no question if you take a long-term view that this could pull back further. I just don't think at the moment, given the washout in sentiment and positioning and everything else, I think we've actually run out of sellers in the short term, which is why a couple weeks ago on Varney, I put myself on a limb. I said we'd be much higher a few weeks out. I think that's going to be the case. If it's not already the case, I don't know if we're higher yet, but I think we'll be much higher by the end of the month as it relates to where we were on that segment. By the way, I'll be on Varney tomorrow morning at 10 a.m. Eastern, so check that out. Very excited. Thank you, Christian Dagger. This is the average path of the S&P during years 1 and 2 of the election cycle since 1928. We've talked about this every week, which is why we told you in the beginning of February, buckle up, Buttercup, and get your shopping list ready. And that's exactly what happened. Here's the blue line here. So 8 weeks in, that's the beginning of February. And then through the end of March, you get another check back retest, which is probably what we're going through right now. And then straight up into the summer, and then some weakness in the end of the year. So I think that the people, we talked about last week, by the way, we're going to be opening up for the small accounts on April 1st. And that you could get in the queue and start to get your paperwork going and get your account approved by Interactive Brokers, so that on April 1st, when we're open, you can fund and we can start to allocate. Not that you kind of missed this whole thing here waiting, and a lot of you have jumped on that. So excited to get you guys in. You can fund before the 1st, but we'll start to put the money to work for you on April 1st. And for those of you who are thinking about coming in, we'll be open for a few weeks, and then we'll close it out for Q2 for the small accounts. Normal size accounts of by the way, our minimum is 1 million, and for normal size accounts of 5 million, there are no cutoffs. You can come in whenever you want. There's bespoke service at that level. And then after this massive amount of money can be made in the first year, then it starts to get, we'll be harvesting profits at full value, finding some shorts, and getting prepared for year 2 of the mid-cycle correction, which can be a bit more bumpier. And we love those type of years as well. But this is where easy money can be made if you're positioned right. S&P and NASDAQ 100, again, seems to be wanting to put in some bottoms here. Maybe we'll retest before we go higher, but you can see the equal weight. And by the way, if you're listening to this on audio, that's super. Keep listening. But if you can, from time to time, tune in on YouTube and watch. And of course, like and comment. That's what keeps this thing going. The more you like and the more you comment, the more they're going to serve it up to people when they log into YouTube, which will give us more and more people watching, which will make us want to do this more and more for both clients and non-clients alike. We will always do something like this for clients. But for non-clients who have been on the free ride money train, do your part and like, subscribe, comment, and let's keep doing this for a long time. All right, Europe rocking and rolling here as we had talked about international versus the US. That's been a huge theme coming into the year. Even UK, Germany started to rally on big stimulus that they announced. Hang Seng has been the Chinese equities biggest performer from uninvestable to investable. All the folks who were downgrading when BAVA was 70 are now upgrading at 140. Just the beginning, ladies and gentlemen, as we flip them all over. Japan struggling. I think that's going to persist because we've talked about the carry trade. They have to continue to raise rates after printing money for 3 decades as inflation kicks in. So that will be continued pressure on reversing the carry trade on the Mag 7, on all the hot money stocks, on all the shiny objects that people chase that are now getting smashed. And these are the people that come up to me and say, when will the pain stop? I'm like, what pain? We don't own any Mag 7. We sold all those in July of last year after buying them in October and November 2022. So here's 10-year yield continues to roll over. I think this is going to go down to the low end of the range. This got up to 480, complete fake out. And I said we were going to see a 3 handle before we saw a 5 handle. Everyone was so convinced it was going to 5, not going to be the case. So we'll probably get another fake out here, maybe back up to 450 before we go lower. But the trend is your friend. Dollar absolutely collapsing. After the election, it took off, faked everyone out. We said, guys, after the inauguration, watch out below. And here we go. This has a lot further to fall. That's also good for even the loonie is getting a bounce now. So that's a good thing. You've got some new leadership there. Not sure it's better than the old leadership, but it's new and at least someone that we can talk to and get back to a mutually beneficial agreement. WTI crude. And look, if all else fails, Wayne Gretzky will run the 51st state and it'll be absolutely incredible. So, all right, there we go. I just lost all my Canadian viewers. WTI crude oil, it's in this range. I think this is going to probably resolve higher and some of the oil stocks are going to go with it. We continue to like our Comstock resource, which we bought much lower. WTI crude. So yeah, again, I'm just not finding anything in oil and gas that makes me super excited, but they're all going to go up marginally. And when I say marginally, they're not going to be doubles and triples other than what we have with Comstock. They're going to be, 30, 50%. And I just won't risk capital for anemic returns like that. Copper. This is Dr. Copper has a PhD in economics. That's a leading indicator for global growth, which tells you that China is coming back, which we know from Alibaba, our largest position, which has fortunately gone straight up this year, which is exciting. Higher highs, higher lows. Looks like some of these semis want to bounce. PayPal, God, I love it here. Every new dollar that comes in, we've been able to pick up some PayPal. We'll be picking up some more VF Corp, all these incredible companies that we're excited about. Generac even has come into a point where it actually add, even though we bought well below 100. I'd love to add more at these levels. Pretty excited about that. And what else do we have here? I think that's pretty much it. So that's Robert Slumer over at RBC always puts out some good charts. Thank you to my friends over there. How Jack Ma's pivot to AI rehabilitated Alibaba. It's a great article in the Financial Times. I don't say that very often, but as you can see here, we're just getting started. And they're talking about the pivot, and they're talking about what's happened. Alibaba revenues have risen steadily as profits have recovered from its recent dip. So you can see here from 2021 till now, even in the most difficult operating environment, now that they've got the governmental tailwinds behind them, the AI tailwinds and all the other amazing things, toll taker with domestic consumption as a focus of the government, they're just going to mint money. And as I like to say, print more bills than the US Treasury. Alibaba's capex is going up. They've got 80 billion of cash. That's a good thing for them to do, to just box out the other people and gain more and more share. China unveils plan to vigorously boost weak consumption. Vigorously boost. So they're putting their money where their mouth is. That is their game plan. They used to build bridges to nowhere and empty cities. Now they're going to get people to spend because they want to be like America. And Alibaba is the #1 toll taker for the middle and upper class spending in China, and that's the spending that matters. Like everywhere else in the world, the top 10 or 20% make up the vast majority of the spending, and that's where Alibaba thrives. Temu sells garbage at the low end, which did okay for a couple years when they were in lockdown and everyone felt poor. But as things recover, Alibaba is going to whip their butts. China banks cut consumer loan rates to record low to spur demand. Hong Kong stocks hit 3-year highs on Trump talks could ease trade tensions. So Trump is going to be having a meeting with Xi. Maybe sooner than June, but it definitely looks like June. Alibaba and other Chinese stocks are crushing U.S. shares. Here's why. This is from a new author journalist at Barron's, not the one that wrote 135 consecutive negative headlines about China and Chinese stocks. Have not seen her write in months now, since Alibaba's been going straight up and she told everyone to get out of it. But all the rest of the authors have been absolutely phenomenon, Kellum included. Why is China spending billions to get people to open their wallets? This is a great article from the BBC, getting serious about spending. And Baba is the key toll taker with Taobao and Tmall. U.S. factory production rises by the most in a year on auto output. So remember, as Jeff was talking about, there may be some pull forward into Q1 with everyone getting ahead of the tariffs on August 2nd. New vehicle affordability approves again in February. So incentives are going up, prices are going down as they're more reasonably sized cars. Hybrids, which have a greater cost per vehicle. All of this is benefiting Cooper Standard. Intel is the best chip stock this year in a surprising reversal. No one is expecting overnight, but investors like Intel's CEO announcement. The last shall be first. I went on Charles Payne last year when NVIDIA was $153, and I said to sell NVIDIA and buy Intel. And after that, he didn't invite me on the show for 3 months. Maybe I'll get back on the show now because it's proved to be the correct call. Although they did call me this morning. They're like, "You in New York?" I'm like, "Yeah, I'm about 2,000 miles away. Can I be there by 2:00? I don't think so. So hopefully I'll do some remotes with them before getting in studio next month when I'm back in the city. Love his show for sure. Dell CEO explains why he thinks the PC refresh cycle is starting. That's who's the #1 beneficiary of the PC refresh is Intel, the hands down leader in inferior chips. B of A survey shows biggest ever drop in U.S. stock allocation. So all these managers selling in the hole. Why lowering the yield on the 10-year bonds is more important to Trump than the stock market or interest rates. This is the critical thing. All mortgages are tied to the 10-year Treasury yield. So if he brings that down, #1, he can refinance the U.S. debt at a lower rate. #2, he can spur house buying, auto buying, everything, get the game going, get nominal growth cranking so that debt as a percentage of GDP goes down. even if the actual debt in dollars does not. And Besant was out talking a little bit about that this week, about a way that they're going to lower the 10-year yield by another 30 basis points. And it has to do with the supplementary leverage ratio at banks. If that is removed, it'll automatically drop 30 basis points to the 10-year yield. Each basis point is worth $1 billion a year in interest payments. So that is a good thing, not a bad thing. And they are all over that. So when I talked about a 3 handle before a 5 handle, I wasn't joking. And now we've got an administration that is deadly focused on it. Confidence in German economy surges as Parliament approves huge spending plan. Boeing sees cash flow improve as jet factories stabilize. That had a nice move this week. Crown Castle finally completed the sale of the fiber business. The stock shot up. That was great. Building products. This is huge news this week with Brad Jacobs over at QXO. He finally clinched a deal for Beacon Roofing. So he now has his platform company, and this is where he will be able to work his magic as he has so many times in the past, whether it was Waste Connections selling to Waste Management, multi-bagger in the late 80s or early 90s, whether it was United Rentals when he got involved in 1997. If you'd put up $1 million with him, it's now worth $74 million, 74 bagger. And XPO Logistics, if you had invested side by side with him, he came in 2011, he invested $150 million of his own money. And it was 160 bagger. That if you had invested $1 million, you'd have 160 million. And right now, QXO, he didn't invest 150 of his own money. He's got so much conviction in this business plan. He's put over $1 billion of his own cash, which is material. And we're invested alongside of him. So kudos to all of my investors who are now able to participate in that, and the game is just beginning. So we'll look for any opportunities to add more and take advantage, because this is one that you just buy, close your eyes, and in 5 years you have a multi-bagger. I think this thing's going to be probably the calculations I did when we got involved sometime back at around I don't know when. Let's see, when was it? I think our base is around $11. I can't find the mouse for the other computer. I think it was $11.76, but I'm cuffing that. But I think the calculation I have internally is like an 8 to 10 bagger over a decade. So I think I was looking at like an $80 to $100 stock. So we'll see. As the facts change, we could change our mind. Usually with Brad, the facts get better as time goes on, so it could be a lot better. So, but that's when you just sit there and let him work his magic. No one has created more wealth for shareholders than Brad Jacobs repeatedly over time. Certainly Buffett has created fortunes for people, but that was a one-trick pony. And a great pony, don't get me wrong, probably the best pony in the world, but Brad keeps doing it over and over, and I love the timing, and I love the play, and I love the fragmentation, and I see what he sees, and then he has this magic touch where he not only does good economic, accretive acquisitions, but he finds a way to put in innovative technologies to really juice the margins and really get efficiency out of and uniformity out of all the acquisitions, and that just drops huge amounts of cash to the owners, and that's all he wakes up thinking about every single day. If you've read his books and you've listened to him and you've seen what he's done for shareholders over the years, we're super excited about that, and glad he finally got that done. And that's what happens. Winners win, and Brad Jacobs is a winner. So U.S. natural gas prices up on record flows to LNG export plants, cooler weather forecasts. So that helps our Comstock. Data center build out stokes fears of overburdening the U.S. grid. Again, Comstock, but more importantly, Generac is going to be the beneficiary. 75% of home standby generators. Lots of penetration to go. Lots of opportunity. They own the space. The Lilo and Stitch trailer has given Disney another brag-worthy milestone. So that's another hit for them. We covered that. Okay, here's the article of the week. You can find it also at their, if you want to know more about Cooper Standard, you can watch it. You can go to their website, the Investor Relations, Cooper Standard Investor Relations site, and watch it there, or look at all their other decks and presentations. Again, all opinion, not advice. This just gives the background of the thesis when we came out with it publicly in 2022, what we were saying then, and some of our past articles about it, which you can find all at hedgefundtips.com. And then the Bank of America Fund Manager Survey came out this week, and we put out the summary. Here are the top 5 points. Largest pullback in sentiment since March of 2020, the bottom of the COVID lows. People are more pessimistic than then, which was unbelievable buying opportunity. Number 2, record rotation out of U.S. stocks, falling to a net 23% underweight. The lowest allocation since June of 2023 was on no one's bingo card coming into the new year. I remember speaking at one of these conferences and talking with some big names that you know very well. They were kind of laughing at me. They're like, oh, you're just contrarian to be contrarian. You know, what's to say international is going to work, blah, blah, blah. And these guys were the ones that were most overweight Mag 7 and pounding the table at the top with all the shiny objects. And that's the way it goes. Record rotation out of U.S. stocks. We got that. Opinion follows trend as most managers are most bullish on China versus U.S. growth since May of 2023. Just beginning. Dividend stocks continue to get bid. Remember last year we were just every single week buy with the largest monthly rotation on record into high versus low dividend yield. FMS cash levels went from a 15-year low last month to their largest 1-month jump since 2021 December. Hat tip to my buddy PV, leave him anonymous. China rolled out an action plan for boosting consumption, which might be the Chinese equivalent of, quote, doing whatever it takes. If you remember, during the European debt crisis in 2011, Draghi came out and said, we'll do whatever it takes, and squeezed all of the shorts and completely destroyed the bond vigilantes. That's exactly what China is doing now. That you are going to see opinion follow trend like nobody's business in the next 12 to 18 months. So much money is going to flow into their equities. It's going to, your head is going to be spinning. They basically want to tap into that $20 trillion plus of household savings, which is on the sidelines, which would put quite a few dollars in the hands of Alibaba. There is a statistic out of there where 40% of Chinese consumption goes through Alibaba, which is unbelievable. I have to verify that. That's why I took it out of the article, but it doesn't surprise me at all. They're the leader in e-commerce, and the percentage of commerce that goes through E is at the highest in China out of any other developed country. Crown Castle update, they sold that off, which is huge. They're not going to use that cash to buy back. You can see cash flow has been great. Stock has been down. Why? Because they had a low return on investing capital on the fiber business, was a drag, losing money. And now they got rid of it, and they got $8.5 billion to boot. So expect them to bring in the share count to invest in more CapEx light towers like their 40,000 legacy, which are cash machines, and the stock goes up. So those of you who listened and locked in the 7 or 8% dividend yield now are going to see from those levels probably doubles over the next few years on top of collecting 7% a year, which is great. Okay. And moving along, we've got, oh yeah, I want to cover ASOS real quick. You can read all that stuff on your own. Okay, so ASOS, while this has been a tiny position for us, we've consistently been on alert for new information that would warrant making it at least a half-size position or even a full-size position. We have yet to be impressed. Our instincts about whether a, quote, consultant could make a good CEO have thus far been proven correct. A lot of talk and not enough action. We hope we are proven wrong and will upsize if he starts to deliver. We do believe this is an incredible business that has huge upside potential. We don't know if they have the right leader in place or not. Free cash flow is certainly starting to improve. That's a positive thing. He hasn't turned revenues yet. He has a strategy for that. we shall see. I'd really rather have a guy like Bracken who has experience with brands, a lot of expertise in doing that. But this one, take a little time. I think they're in a decent enough position. They've got a decent enough runway. It'll be good. And at any week, we could be getting on and saying, okay, I see the light at the end of the tunnel. Let's make it a real position. But we're just simply not there yet. I'm very skeptical about this. I have been, but we very rarely ever do a mini position. It's either going to be a full position or it's going to be nothing. But this one had all the makings of a perfect turnaround situation. I still think it does. I hope this guy can execute on it. If he can't, I think there's plenty of runway. They could get someone else in there who can. But there's no reason yet to make it a real position. And we'll leave it at that. Okay, congratulations to all the new clients that came in during our 2024 and Q1 2025 raises. You could not be better positioned for what we believe will continue to be a highly rewarding year in 2025. Not many people can say that this year, which is surprising to us because it was pretty clear what you had to do coming into 2025, which we told every single week, lighten up on Mag 7. I mean, we sounded like a broken record. Producers would be like, again, the same message. International, yeah, again, the same message. This view is based on what has already taken place in 2025, as well as the data we've shared in recent weeks on our podcast VideoCast, coupled with our proprietary methods of expressing and executing upon those ideas on your behalf. The weightings, the derivative overlays, I mean, the secret, what goes on behalf of the clients is stuff that you can't reverse engineer from listening to the podcast. But if all you did is buy the names, you're doing great. And we're very, very appreciative of the names that we've made public. You guys doing a great job and all the kind notes that we've been getting. So we will reopen on April 1st. We are having the conversations, getting people's paperwork processed before that, and we'll deploy starting April 1st. You can go to the website at hedgefundtips.com, click on money management, or just the article of the week, click there, and we'll be in touch. Consumer discretionary top 30 weights earnings are actually down 1.8% in the last 60 days, and for next year down 93 basis points. So again, we're still in sandbagger season where they take estimates down the first quarter and then they beat all year and take them up. 2026 estimates have not come down, surprisingly, so it's all back-end loaded as it is every year. Same thing with staples, same exact story. That just creates opportunity for people like us and you. And let's see if there's any major stuff that we wanted to cover here as it relates to economic data. Nothing that stands out this week. Earnings came down from 275 to 271. That's held static. And with that said, the podcast is over. We're going to stick around for a lot of AMA questions for those of you who find value in that. Let's get started. The rest of you will see you next week. Griffin Brown asks, as a recent college grad, what do you recommend I look at, read on a daily basis to stay up to date? Don't have money for tons of subscriptions. Still feel like I'm out of the loop. Blah, blah, blah. Very fortunate family friend. Okay. So, Griffin, number one, I mean, first of all, the basics, Wall Street Journal, Bloomberg, CNBC, Barron's, for sure. Barron's is the best financial publication out there. And the most important thing you want to be reading, the best thing I would suggest to you is, first off, read the book, The Intelligent Investor by Ben Graham. Second thing is you want to be reading annual reports. You should read one annual report per day or per week. I mean, 50 in a year is pretty good. Get to know maybe the top 50 weights, maybe just a Dow 30. If you read the annual reports of all of those, that would be pretty valuable in a half a year. And then start to work your way down as you find companies you're interested in. Just start to learn businesses. You could read the value line sheets to learn, maybe 5 businesses a day in a cursory way. So then you can say, oh, out of these 5 businesses, I really like whatever it happens to be, and then you pull their annual report, and that's one of your 50. That's the most important thing. As far as the noise in the headlines, you got to know what's going on, but the way you're going to make money if you're trying to get into the business is to learn companies and be ready to act when their price gets dislocated, and that's what we do here. So, Lee Foster. How do you go about weighting your portfolio? Do you have a scoring system? Struggle with balance allocation? Yeah, that's kind of special sauce for my clients, but the higher conviction, the bigger the weight is part of it. But we also recognize that we have a repeatable framework. What we can control is how we analyze the financials. What we can't control is the timing in which price confirms the underlying strength of the business or the intrinsic value of the business. So that's why we'll have 8 to 12 companies, because some are going to get to intrinsic value and beyond much faster than we ever anticipated, in less than a year. And some take longer than we anticipated, 3 to 5 year range, and they balance out by doing that. So it's a combination, and then there's like 20 years of experience that goes into it. Like, why would I have the instinct when ASOS's fundamentals, for instance, passed through my screen? It was a little bit hairy, but why would I have the instinct to make it such a small position? Is because I was very uncomfortable with the CEO, and watching him talk, he's fine. He believes in what he's doing. I mean, he's not trying to pull one over, but I've just met these these consultant types. He's probably done his part for what he can do in terms of the easy stuff, but the next phase is probably going to require someone else for us to size into it, is my guess. But that just comes from experience and seeing the types of CEOs that are full of shit and seeing the type of CEOs that actually get stuff done. Brad Jacobs is the exact opposite end of the spectrum. Little talk, lots of action, huge focuses on what matters. He creates shareholder value, and the rest takes care of itself. Delights his customers versus try to sound cute at investor day meetings. So that's what I would say about that. It's experience. Many thanks for the great work. Also great work on the interview. What do you think about Forvia? Aren't the fundamentals better than Cooper Standard? All right, let's see. So these are all the people who missed Cooper Standard, didn't want to get in with us when it was at $5. So now they're trying to find things that are quote unquote better to catch up. So number one, this is a French company, I guess, which is probably an immediate no for me. FOR, unless it's LVMH. VIA. I can't find this. Gross margin, let's just see here. Here we go. Description. Sells automotive technology solutions, seating, clean mobility, electronics, lighting, vehicle seats, exhaust systems for fuel cell centric vehicles. No one gives a shit about fuel cell centric vehicles. Display technologies. All right, let's take a look at the financials. It seems like it's generally okay. All right, financial analysis, return on invested capital. Free cash flow. take a look at the balance sheet. $10 billion of debt, $5 billion of cash. Income statement. Why is there so much dilution here? I hate this. They've almost doubled their share. I mean, not their share count's up 70%. If the financials were good, I don't like this. This is, by the way, this is what angers me about the ASOS CEO. He diluted shareholders by about 20% because he couldn't think creatively and get the job done. So I hate CEOs that do this kind of stuff. So for me, the fundamentals look great. This is bullshit. So not for me. And I emphasized that on the call with Jeff and acknowledged him, because if anyone should have diluted the shareholders or almost had to during the crisis in COVID, it was him, and he did not do it. Why? Because he's a partner. He owns 350,000 shares, 2% of the company. That is material. And that's why they don't screw us, because they would be screwing themselves. My guess is if you look at management ownership here, either part of the delusion is them giving themselves all these shares. Forget it. This is a French scam. Not interested. I don't care how good the fundamentals look. When you screw the shareholders like this, go to hell. Next, Micah Kelsey. Your podcast is incredible. I listen to every VideoCast right when it drops on Thursday nights. Well, thank you very much. Appreciate that, Micah. The interview with CPS was excellent. Okay, so he's asking why doesn't he own more stock? I mean, the guy personally owns 350,000 shares. We own a lot more than that, but he's one guy. I mean, he's going to make, I mean, if he does this right, the guy's going to make personally, I mean, he could make 35 to $70 million if he does it right. So I don't think that's a small amount for if you look at his salary. I mean, he's not running Coca-Cola here. I mean, running a small cap company to be able to go off into the sunset with $70 million is nothing to shake a stick at. So Rue Reynolds, awesome interview with Jeff Edwards. Thank you for and posting it online. Yeah, well, they posted it first, and then we posted it after, based on some of the insights. Based on some of the insights that weren't in your base case. Look, these were known to us, but we always shave off the whipped cream. The whipped cream is just going to be extra whipped cream for us about the cost per vehicle, China mix shift, hybrids, etc. But if you listen carefully, which is why I'm so interested to see who wins this contest with their takeaways from the interview, because, there's nothing, if you did your work, there's nothing new. It's just he did a really good job of explaining what we've been talking about here for 3 years because we did our work. So, and it's nice to hear it from the CEO versus just some guy who does his work. If you're going to allocate a lot of money to something, you better know it inside out and upside down. So yeah, add up the two numbers that I gave on the call, and then add a little bit more based on some of the things that you think are new information that we've known, that we basically were aware of the trends from listening to the quarterly conference calls, but we don't factor it in because that's upside. Like the sneakers, React X, okay, that's probably going to make some good money, but it's like we have zero attributed to it. So the AI stuff, the consulting that they're doing, all that stuff, they're going to make money on it. We have it as a zero. We had China as a zero, so now it's going to be more than that. That's great. We had Europe as a zero. It's going to be more than that. So fantastic. But even if you underwrite the downside, the upside, what I think is amazing from that interview is just the fact is if the volumes stayed where they are, the amount of money that they can make 2-3 years out. Blew my mind. And God forbid we go up to 17, 18 with 40% more population. I think we could do 18, 20 if everything clicks all at once. It takes years and then it happens all at once, ladies and gentlemen. Jared Bentley. First of all, love your podcast. Really appreciate all the hard work you put into it. Your insights are incredible. I recently tried blah, blah, blah. Okay. Okay, cool. Don L. What's your thoughts on leases being treated as debt? Don, who cares? It's like old news. It's a year and a half old. There's nothing we could do about it. We focus on things we can control, not things we can't control. Should it be treated as debt? I can see the argument for that. I personally don't think it needs to be, but it is. So on to the next. JT Investor. Tom, amazing job getting Jeff Edwards on the podcast. Yeah, they'll be fine, JT. Thanks for the advice. Theo Dujardin, thanks for all the education you're providing. I'm sure you made people looking at the business and not just stocks, which are things that go up and down. The Buffett of our age. All right, that's very kind. There is no other Buffett, period. And my name is Tom Hayes. I appreciate the compliment, but no one can be compared to Buffett. And if you've noticed our framework, while the core principles are the same that Buffett took from Graham, we have our own flavor of how we like to do things as well. My question relates to when you see the margin of safety is sufficient. After a recent drawdown, what do you think about Cloudflare? I think Cloudflare is going to be like Blackline. And I'm going to, like Buffett, it's like you really have to be, you got to be damn certain that you have a defensible moat. So look, this thing is up 12x and now it's pulled back 5 cents and you think it's a bargain. It's funny. One of the questions we have here, I actually want to address it. So by the way, I don't even have to look at Cloudflare. It's a no for me, but, oh yeah. So this lady, Shannon Sabin asks, hindsight being 2020, no doubt many of us should have followed your opinion, not advice sooner, but a question for you. Looking back, now that you know what you know, anything else you would have done or thought about differently if you could do it all over again? Well, as it relates to BABA, I mean, the bad news is I would have the bad news is I would have preferred to buy my first share a lot lower. The good news is the work that I did was so comprehensive that I was able to buy down every time that it took longer than we wanted for it to go and bring our basis across all accounts to $83. So if it hadn't taken so long, I wouldn't have half the position or even a quarter of the position that we have today. So it's been the best thing that ever happened to us. Now, that said, what would I do differently is, and you probably noticed it in the last year, is broken momentum stocks I stay away from. So they really have to put in a base for a while. Like, if you look at PayPal, for instance, this was another broken momentum stock. And, we were kind of waiting down here until it had bottomed for a year and a half before we got aggressive about it in the low 60s and high 50s. So I would say that we're quicker to recognize when a growth stock is broken and wait to be looking after a couple of years in here versus at the first sell-off in here and then having to average down before you get the recovery back. So, and this is kind of a perfect example of with Cloudflare is, and a lot of people send us stocks that are up like 20x and they just pulled back, 30 or 40%. And they're like, they want to jump in because they're stuck in recency bias of the success. But these things, when they crack, they tend to because they hurt so many institutional shareholders, it takes an awful long time to rebuild that institutional base, which is why a lot of these take a couple of years to build bases and get a new CEO, get a new plan, and then after they've done that, then you get the first move, then you get the pullback, and then it starts to go. Same thing with Baba. And Baba had a couple fake outs because of government stuff that you can't control. So this was a fake out here. And then it took another year. We bought a ton more stock. And then you got the move here, fake out. And now it just wants to go. And we saw something similar in 2017. You can look back, you got that fake out. And then once it goes, it's straight up. Day to day, you'll see up $5, down $10, but it's lower highs, higher highs and higher lows all the way up to the promised land. And I think this time will be no different. So I would say the only thing I would do different, but that's why we've always had the 8 to 10. I mean, is because our work was really good. And we knew what we owned, which is what gave us the confidence as it was going against us and everyone was crying uninvestable and ADR and all that bullshit that's completely useless noise. We kept adding. So on the one hand, we're more careful about buying broken growth stocks that haven't been broken for more than a year or two. On the other hand, nothing's changed in our framework. That's just kind of technical bullshit noise. That'll just give us a hair better timing, but we'll wind up with smaller positions because we have less time to know the company and less time to accumulate. So I kind of like how it worked out, but that would be the one key learning lesson. Thanks again for all you do. What are your thoughts on coal company BTU? We've gone through this one. I think the financials look fine. But it's not something we really want to be involved in. We'll just stick with natural gas for now. Interestingly enough, what did this thing do under Trump 1.0? Well, that was COVID. Well, it started crashing before COVID, actually. So, all right, I'll take a quick look. You're probably going to get a bounce here, so I don't want to tell you to pass on it, but cash flow and revenues are all turning negative. So I'm not sure that gives me a lot of confidence. The stock price reflects it. Question is, let's take a look at quarterly, see if they're actually turning at all. I don't want to be involved in this. All right, River, we're playing that through Comstock, and we have a lot of reasons and a lot of outs with that. This one, it's just too binary. I had a friend who bought a ton of met coal private deals in 2011, thought he was a genius, lost every penny. River Ray, what do you think of super low pro shoe Vans? Good step, in my opinion, towards marketing toward women. I leave those hard decisions to Bracken. I just hire the jockey. He takes care of that stuff. I think they look super cool. I think he's going to figure it out. All he's got to do, he told you what he wants to do. If you listen to all the calls, he wanted to destock. And then once he destocked, then he was going to get the machine going with advertising, influencers, etc. So once you see these things on Sabrina Carpenter or whatever, every single 12-year-old girl will buy them, and it will be off to the races. And people will say, "Wow, how did the stock go to $40? It's too expensive now." And then at 60, they'll buy it, and then at 100, it'll be disbelief. But this is not a guy you want to bet against. Daniel Borkman, thanks for the awesome podcast, Tom. What are your thoughts on Generac rebound? I mean, look, we bought it below 100. It's up huge for us. So would we put new money to work here? 100%. As new client money comes in, probably Generac will be on the list at these levels for sure. Easy peasy. Jack Corners. Cornez, thanks for all you do for us. ASOS, okay, we covered that for you this week. Nothing yet for us. Patrick Kelly. Thanks for all your hard work. I found you by accident when I told a friend that I was going to start a position in Alibaba in early 2023. He told me to check out your weekly podcast because you were also long Baba. Then thanks for helping me stay the course through the long sideways grind. You're welcome. It wasn't an easy time, and it was a very lonely voice. But Oh, he says, I'm curious if there are any money managers in the business that if you found out were on the opposite side of one of their trades would make you go back and check your work? Answer is no. As a matter of fact, I've had some of my most successful positions have had multi-billionaires on the other side of the trade. I mean, being long the market in 2022, I had Ray Dalio on the other side of the trade. I mean, who could scare you more than Ray Dalio, one of the best hedge fund managers of all time? It's been bearish the whole way up since 2022. So, no, I do my own work. I don't read a lot of secondhand material. I always go to source material. Just as God didn't give me the FOMO gene, he doesn't give me the distraction gene. I do my own work. I draw my own conclusions. I have my filters. Would I put 100% of my net worth into this to buy the whole business if JP Morgan was going to finance the debt? And the answer has to be yes. And to come to a yes answer is not casual. It's not some technical, stupid breakout pattern like all these schmucks talk about on TV. It's about knowing what you own and what are the current prospects of cash generation and the future prospects of cash generation and the leadership and all that goes into it and the channel checks and the competition analysis and just instinct, and seeing what works and not, and instinct on people is a big thing as it relates to the jockeys that are running your business for you. Axel B covered that. Zach Hong. Okay, he's asking which college to go to. Okay. Rick Richard. Okay, so Rick, by the way, Rick's a super smart guy. Longtime listener, congratulations on winning #1 podcast recently in the hedge fund category, by the way. Well deserved. Can you explain a little more about your framework for setting exit valuations? Is a lot of comps based on enterprise? No, it has nothing to do with comps or any of that. How often do you find yourself allowing to reset the price higher based on new information, or vice versa, lower exit price? If I'm taking my exit price down lower, I might be thinking about getting out of the position completely. That rarely happens. And I can't think of any time it's ever happened with a full-size position. So I'll leave that. As far as taking it up, I think with Bracken, it's definitely changed. I thought it was going to be a quick double to 45. Well, that would have been a triple to 45 and we'd be out. Looking at what he's doing and how he's thinking about it and his background, I do think he's going to take this thing to new highs and beyond. But I have to see quarter to quarter, what he says and what he does. So far, he's doing exactly what he says, just like Shane O'Kelly with Advanced Auto Parts, by the way. But if I get a couple quarters where they're changing what they say or taking their expectation down, then I have to adjust. I haven't seen that yet. Will I take it up? I think that's exactly what Bracken talks. But it usually has to do with cash flow. It usually, and then there's just a million factors that go into when I know it's reached the crescendo. And a lot of you have been with me for these exits, and I usually get pretty damn close to the top, which is just, maybe some of it's luck, but most of it is just experience. And oftentimes it's not binary. We'll usually keep a trailer on, because just as these companies overshoot to the downside, they tend to overshoot to the upside, overshoot to the downside with despondency, overshoot to the upside with euphoria. So we're getting in tranches and getting out in tranches around that intrinsic value. But a lot of the secret sauce comes down to cash generation, how it, in the businesses that are cyclical, that's pretty easy for us to know where we want to be out. And but as far as it's peers are trading at this and that, I'd be more interested in looking at its historic multiple channel than its comp multiple channel, because there are unique attributes to each business that we own and proprietary moats based on the technology and or the products that they have and or the brand equity that they have. So it's not a simple answer, but we do know when things are pushed to the top of ranges, and we do know kind of what the max out earnings power is going to be for the type of businesses we're buying. If you're buying the guess the future businesses, there's no way to tell. There's absolutely, which is why we don't do those. If you notice, all the businesses we buy have been around for 5, 10, 20, 30 years. So we can see how they operate through different cycles and how they're proven to operate through cycles and where they tend to peak out in the next cycle. And that's a little easier than saying, you know, this thing's the next future of whatever, curing cancer or, you know, Bitcoin or all these things that you're just guessing. And then you got these people looking at charts thinking they have some edge. It's comical. So I buy businesses that I can understand how they operate, how they recover, and where they come out in terms of relationship to intrinsic value and in excess of it. And that's kind of how we think about where we're getting out in the future. And we adjust based on if management does a lot better job. And we might miss upside on that, but that's okay. We know what we have to get out of each investment. What is this? Jason Patel. Oh, okay. He's talking about the China thing in CPS. Gleb Sidikov, thanks for your podcast. It's probably the most efficient 2 hours spent per week. Tremendous value packed in each episode. Five Below. I think a lot of these tariff hit retailers are going to make a comeback, whether it's Dollar General, Dollar Tree. Let's take a look at Five Below. Probably Five Below, maybe even Target. I think you're probably okay there. Let's just see here, though. I want to see. Yeah, so this is a broken momentum stock. This could certainly bounce back straight back up for sure. But it also wouldn't surprise me when it's broken like this if it takes a few years to build a base. So that's kind of the nuance. So, I mean, looking at the financials here, my guess is we're going to come to the conclusion that it does make sense to buy it. But in terms of the reality of all the broken investors in this thing, this was a 10 bagger that is now broken. The one takeaway would be, okay, let's talk about it in a year. And if it's between, 40 and 80, let's start to build a position. And you're like, why would you do that if the revenues continue to go up and the earnings continue to go up? Because so many people chased up here at Euphoria, they're just broken and they're stuck with recency bias that it's broken forever. Like you're seeing, like you saw in Baba as it built the base, like you saw in PayPal as it built the base. These people are broken mofos. They lost a lot of money because they chased up here after the 26 bagger and they bought this thinking it was cheap when it was a broken momentum stock. So with this one, I would, let's just take a look at the cash flow. Yeah, I mean, everything kind of looks okay. $1.7 billion in debt, 500 in cash. Probably going to be generally okay, but I wouldn't be in a rush. I'd probably pass. Like if I missed the move from 60 back to 200, so I missed it. But like if this thing languishes for a couple of years and builds a base and, all the hurt people get out of the stock at the lows, then it becomes more interesting. So that would be a lesson that I took away to answer Shabin's question, which was a good one. Jimmy Jones, Unilever, we've covered that. Let's just kind of snore. Unilever. Yeah, nah, not for me. Next. Why are you sending me 2 this week? Jeppy. Wait. If you're inclined to build an income or covered calls, look. No, why are you screwing around with this kind of nonsense? Look, if you like a company, just buy the damn company. Why would you want it called away from you? All this bullshit about, oh, the stock went down, and then you hear them say, but I wrote covered calls on it, so I got $1, and the stock's down $40. It's like, wow, you're brilliant. Like, simplify. That's all I'm going to tell you guys. Just simplify your lives. And you don't have to screw around with that stuff because it works for a while and it doesn't. If you want to get into the options game, learn how to sell them, not how to buy them. Now, what we do for clients with the overlays and the long dated, if you're going to be a buyer, you want to be over the long term. If you're going to be a seller, you want to be in the next 30 days where you get the time decay. But that's like a 4-hour conversation, which I'm not going to have. Jason Zen. Jason goes into Trade Desk based on last week, and he has experience with it, and he's a pass, trying to give me some insight on the technology. I appreciate that because I asked for it. John Liu, by sheer chance, came across your weekly podcast. Confidently say it helped me find my footing in investing going forward. I appreciate all the work you've done. Okay, so the CPS question was answered. Carolyn H., first, thank you for helping us all understand what makes Mr. Market tick. You're welcome. By the way, thank you for all these kind comments, guys, because a lot of work does go into this. And all right, grateful to be out of the mainstream view of stocks and into the method of understanding value in business I own part of. There's been a lot of talk about recession lately, which got me thinking. Obviously, recession shouldn't change the framework for picking high-quality business at a dislocated price, but does it change the strategy for acquiring them? Perhaps they might take longer for price to reach intrinsic value. Anything else to be thinking about? I think you answered your own question. If you get a recession, it just takes longer. But if you start getting in the predict a recession game, good luck, because you'll be in the Dalio camp for the last 3 years and miss 100% ups. VSCO stock. Victoria's Secret. They destroyed this brand. I mean, the bottom line is, there's no way I'm going to say this that is going to sound nice, so I'm probably not going to say everything that's on my mind. But the bottom line is, lingerie is supposed to be sexy, okay? When you try to make it something other than that, then you're not selling lingerie and you lose the cachet for the whole brand. When Victoria's Secret hummed, they had the supermodels. Now they don't have supermodels because they don't want to pay them all that money, so they just put women up. And long story short, I think this is completely destroyed. My guess is they're trying to reverse that. VSCO. Yeah, there's no thing is there's some stability here, but there's no inflection yet. And that's so all I can tell you is I would want to understand, is there a new CEO? What's their plan? What is their track record of success? And on those bases, you know, if they get back to their roots, kind of like what Vans is trying to do right now, and that's what Bracken did. He spent time getting to know the family and learning the business from the 60s forward. He knows the business like the back of his hand and the culture and everything else. Then I think there's a chance. But, you know, that's hours and hours of conference calls, learning the whole thing. And it looks like they might have troughed here. So I think it warrants further investigation. I do and have heard in reading articles, etc., that they are moving back toward what made them successful. So if you can get some confidence around that, it's probably worth a look. Yeah, share count has come down. So some things are going in the right direction. Sounds like they've got someone new running it and doing it properly. So Mehdi, thank you for bringing it to us. I think it warrants further exploration. All right, I think we got a couple more here. Oh, Valaris, offshore driller. Okay, so Vile wants to know about Rick Hospitality, which is a roll-up of nudie bars. Okay, the guy who did this, I got pitched on this when I was in Puerto Rico, and the pitch is fantastic. The guy who actually runs it understands return on invested capital, understands how to do a roll-up, understands how to do a business. What he doesn't understand is the fact that no institutional money manager that wants to keep his job is going to have a big position in strip clubs, and that's why they're never going to get the sponsorship that they know. So I would bet on the guy if he went into another roll-up. The fact that he's in this roll-up, it's going to be very, very, very hard to get the type of sponsorship you need to have a monster winner. So on that basis, I'm a pass. Let's take a look at Valaris. These are all the guys wanting to get offshore drillers. The problem with this one is it hasn't been around long enough for me to be comfortable with it, but I'll take a quick look at the financials because I do think these servicers are going to move. I would pick something easier like, maybe Halliburton or maybe National Oil Well Varco, but that one's a stretch, or maybe Schlumberger. I mean, that's one's kind of a no-brainer, but the key is there's not enough margin of safety. So this is still negative free cash flow. Revenues are going up. It's too new for me, so I'm a pass on this, and I'll leave it at that. Okay, that's client inquiry. And that's it. So we'll be back next week, same time, same place. In the meantime, make it a great one. Thank you for tuning in. Bye for now.